How to qualify for $100,000 plus business credit lines in 2026. Before we start, you may see a few ads. Thank you for letting them play, so I can keep bringing you free, actionable advice. Now let's continue. If you're a business owner who's been turned down for a six-figure credit line, or if you're building a company and want to position yourself for serious institutional funding before you actually need it, what I'm about to share could be worth tens of thousands of dollars in interest savings and operational flexibility. This is the same framework that commercial banking relationship managers use internally when they're evaluating high-limit credit applications, the kind of strategic intelligence that typically costs $300 an hour from a business finance consultant. By the end of this video, you'll understand exactly how banks assess creditworthiness for six-figure business lines, and more importantly, you'll know the specific steps to engineer your business profile to meet those institutional standards. Let me start with something most business owners get wrong. They think business credit works like personal credit, just with bigger numbers. That fundamental misunderstanding costs them approval after approval. When you're applying for a $100,000 or larger business credit line, you're not dealing with automated underwriting systems anymore. You're dealing with commercial credit analysts who are trained to assess business risk using a completely different framework than consumer lending. They're looking at cash flow stability, industry risk profiles, business structure, and most critically, something called debt service coverage ratio. This is the ratio of your available cash flow to your total debt obligations, and for most institutional lenders, they want to see a minimum of 1.25 to 1, meaning you have 25% more cash coming in than going out after all expenses. Understanding this distinction is the first step toward positioning your business correctly. Now let's talk about the actual qualification framework. Banks evaluating high-limit business credit lines assess 5 core pillars, and you need strength in at least 4 of them to get approved. The first pillar is time in business. For a $100,000 credit line, most institutional lenders want to see a minimum of 2 years of continuous operation under the same business entity and EIN. Notice I said the same entity. If you've restructured from an LLC to a C Corp or changed your EIN, that clock resets in the bank's eyes. This is why business structure planning matters from day one. The second pillar is verifiable revenue. They're looking for consistent monthly revenue that demonstrates your business can service the debt. For a $100,000 line, the general benchmark is annual revenue of at least $250,000 to $500,000, depending on your industry and profit margins. They verify this through tax returns, bank statements, and for larger lines, audited financial statements. The third pillar is business credit profile separation. This is where most applications fail. You need to have established trade lines reporting to business credit bureaus like Dun & Bradstreet, Experian Business, and Equifax Business. Banks want to see at least 5 active trade lines with perfect payment history over a 12-month period. These can't be personal credit cards you use for business. They need to be accounts issued to your business EIN that report to business bureaus. Vendors like Uline, Quill, and Granger are excellent for building this foundation because they report to all 3 major business bureaus. The fourth pillar is your personal guarantee strength. Even though this is business credit, for lines over $50,000, virtually all lenders require a personal guarantee, and they will pull your personal credit. They're looking for a personal FICO score of 680 or higher, ideally 720 plus. But here's the nuance. They're not just looking at your score, they're looking at your personal debt-to-income ratio, and whether you have derogatory marks related to business failures or bankruptcies. The fifth pillar is collateral and cash reserves. 4 unsecured lines, meaning no collateral required. Banks cap most businesses at $50,000 to $75,000. To get into six-figure territory, you typically need either accounts receivable to pledge, equipment, real estate, or significant cash reserves. The standard formula is they'll lend up to 80% of eligible accounts receivable or 50% of equipment value. If you're going the unsecured route, they want to see cash reserves equal to at least 3 to 6 months of operating expenses sitting in your business checking account. This demonstrates financial stability and gives them comfort that you won't default at the first sign of revenue disruption. Now let's address the biggest mistake I see. Business owners apply for six-figure credit lines before they've built the foundation. They have 18 months in business, 3 trade lines, and $150,000 in revenue, and they wonder why Chase or Bank of America turns them down. Here's what they don't understand. Every declined application leaves a hard inquiry on your business credit report, and multiple inquiries signal desperation to underwriters. The right approach is to spend 12 to 18 months intentionally building your business credit profile before you ever apply for a high-limit line. Start with vendor accounts, move to small business credit cards with $10,000 to $25,000 limits, establish perfect payment history, and only then approach institutional lenders for six-figure facilities. Let me walk you through the strategic sequencing. Month 1 through 6, establish your business entity properly. Get your EIN, open a dedicated business checking account with a regional or national bank, not just an online bank, and set up at least 5 vendor trade accounts that report to business bureaus. Make sure every single payment is on time. This is non-negotiable. Month 7 through 12, apply for your first business credit card. Target cards from American Express, Chase Inc., or Bank of America that offer initial limits of $10,000 to $25,000. Use the card for 30% to 40% of your monthly expenses and pay it off in full every month. This establishes revolving credit history. Month 13 through 18, if your revenue is tracking toward $250,000 annually, approach your primary business banking relationship for a small term loan or equipment financing, even if you don't strictly need it. A $25,000 term loan with 12 months of perfect payments is worth its weight in gold when you apply for a larger line later. By month 18 to 24, you're positioned correctly. You have 2 years in business, established trade lines, a business credit card with perfect history, and ideally a term loan or equipment note that's been serviced flawlessly. Your business credit report shows depth and maturity. Now when you approach a lender for a $100,000 credit line, you're not a speculative risk, you're a proven operator with documented creditworthiness. Here's the part most advisors won't tell you. Where you bank matters as much as your credit profile. If you've been banking with Wells Fargo or Chase for 2 years, keeping $50,000 in average daily balances, processing $30,000 a month in deposits, you have relationship equity. When you apply for a business line of credit, the relationship manager can advocate for you internally because you represent revenue to the bank through deposit balances and transaction fees. A cold application to a bank where you have no relationship is much harder to approve. This is why I always recommend business owners establish their primary banking relationship with an institution that also offers robust business lending and maintain meaningful deposit balances there. Let's talk about the application process itself. When you're ready to apply for a $100,000 plus business credit line, you need to prepare a complete financial package. This includes your last 2 years of business tax returns, year-to-date profit and loss statement, current balance sheet, and 12 months of business bank statements. For lines above $150,000, they'll also want accounts receivable aging reports and a detailed business plan explaining how you'll use the credit line. Don't just say working capital. That's lazy. Explain specifically inventory purchase for Q4 seasonal surge, bridging receivables timing gaps, or capitalizing on early payment discounts from suppliers. Lenders approve specific use cases, not general needs. One advanced strategy that high-level CFOs use is the cash-secured credit line technique. If you have $75,000 to $100,000 in liquid assets, but you want to preserve that cash for operations while building business credit, you can place those funds in a certificate of deposit at a bank and get a credit line secured by that CD at 100% loan-to-value. You're essentially borrowing against your own money, but the benefit is twofold. First, the interest rate spread between what you earn on the CD and what you pay on the line is often minimal, sometimes just 1% to 2%. Second, and more importantly, you're establishing a 6-figure credit line with perfect payment history that reports to business credit bureaus. After 12 to 18 months of perfect payments, you can often convert that secured line to an unsecured line, or at minimum, you've built the credit profile to qualify for additional unsecured credit elsewhere. Let me give you the bank's internal perspective. When a commercial credit analyst reviews your $100,000 credit line application, they're scoring it against their institution's risk matrix. They assign point values to time in business, revenue stability, credit history, collateral, and industry risk. Your industry matters more than most people realize. A software consulting firm with $400,000 in revenue might get approved where a restaurant with the same revenue gets declined, because the bank's historical loss data shows different default rates by sector. This is also why having industry-specific expertise on your team, or at least demonstrating it in your application materials, can tip marginal applications toward approval. Here's something critical about credit line usage that affects your ongoing relationship with the lender. Once you're approved for a $100,000 line, how you use it determines whether they'll increase it later or cut it. Banks want to see utilization between 30% and 50% of your available credit, not zero and not maxed out. Zero utilization signals you didn't need it, which makes them question why they approved it. Maxed out utilization signals financial stress and makes you a higher risk for default. The sweet spot is using $30,000 to $50,000 of a $100,000 line, paying it down, running it back up in a healthy revolving pattern. This shows you're using the facility productively while managing it responsibly. Before ending this video, let's summarize the vital and critical information. First, understand that qualifying for a $100,000 plus business credit line requires a minimum of 2 years in business under the same EIN with annual revenue of at least $250,000 to $500,000. Second, you must separate your business credit profile completely from personal credit by establishing at least 5 trade lines reporting to business credit bureaus with 12 months of perfect payment history. Third, your personal credit still matters. Maintain a FICO score of 680 or higher and minimize personal debt-to-income ratio. Fourth, build strategically over 18 to 24 months, starting with vendor accounts, then business credit cards, then term loans before applying for 6-figure credit lines. And fifth, Establish a strong banking relationship with meaningful deposit balances at the institution where you'll eventually apply for credit. Relationship equity dramatically improves approval odds. If you found this breakdown valuable, subscribe for more institutional-grade business finance content. Like this video if it gave you clarity on how to position your business for serious credit facilities. And drop a comment letting me know what specific business credit topics you'd like me to cover next. Whether it's business credit card stacking strategies, SBA loan qualification, or how to negotiate better terms with commercial lenders.